Hello and welcome to our latest investment film. Investment management works in practice, but not in theory. I'll say that again. Investment management works in practice, but not in theory. The financial crisis brutally identified what does and what doesn't work in economics and finance. Several theories were exposed. Fortunately, we can learn what good practice is from our own experience and also from the experience of the best investment managers. We often say that mastering financial markets over the long term is both an art and a science. Well, the art in investment management is to tweak the science. Let me give you a couple of examples. In theory, the quality of the financial system does not change over time. In practice, the linkage between credit markets and interest rates has markedly changed since 2008. This is because of the adoption of massive liquidity injections into the financial system, commonly referred to as quantitative easing. It will change again when this policy is eventually discontinued. This is why it is so important to look forwards and not backwards when designing investment portfolios. At this stage, a health warning is in order. In deciding which future to prepare for, you need two things: a well-grounded opinion about what's likely to happen and a clear view on the probability that your opinion is approximately correct. Almost every investor has an opinion, but I think relatively few think about the probability that their opinion is approximately correct. In practice, some of our investment managers recognize regime changes of the financial system ahead of time and create value by way of capturing the upside or better managing downside risks, or both. Understanding the difference between certainty and likelihood can make all the difference. In theory, some assets like US Treasury bonds are perceived as risk-free. Such assets should exhibit no dependencies and no difference between expected and actual returns. Well, we understand the gilded edges have come off some investments. I hope it is not too immodest of me to say that I believe we at Lloyds Bank have found a good way to navigate the risk spectrum between savings and investments. In theory, risk diversification is an easy and obvious practice to adopt. Countless times you will have heard the old metaphor about not putting all your eggs in one basket. Some investors may think that they have a diversified portfolio simply because they hold a mix of assets. In practice, true diversification means far more than merely investing in many different stocks, bonds and properties. The process of diversifying risk could involve combining investments or strategies that add risk, some that reduce risk, and some that exploit market anomalies, irrespective of general market moves. As you may know, this effort is typically referred to as risk budgeting. The key for us is not to get depressed about which theories aren't working. We need to focus instead on best practices that we believe would add value to your assets. After all, this is why our clients come to us at Lloyds Private Banking. In summary, there are at least 5 virtues of long-term investing. In theory, there is no difference between theory and practice. In practice, there is. Adopt a healthy skepticism to well-established beliefs and methods in investment management. Truly diversify by way of smart risk budgeting. In the post-2008 world, instabilities are possible at any scale and any time. As a result, we must build portfolios which are as robust as possible. Focus on assessing the remaining lifespan of the current financial market regime at any point in time. Today, returns have memory. Consequently, trends are more common these days than they used to be. Identifying imminent trend reversals early is a key success factor. And finally, understand the probability of your opinion being correct. We in the Wealth Investment Office at Lloyds Private Banking have put diversification at the top of our agenda for 2015, and we look forward to updating you on our progress in the coming months.